In this video, I'll take a look at one of the most basic concepts when it comes to technical analysis and, quite frankly, any trading system that most people use, and that is support and resistance. Simply put, support is an area where the market is supported. So maybe it's been falling, but it can't quite break down. Buyers are coming in to support the market. Alternately, resistance is just the exact opposite. So sellers come in and they push the market lower. Now, what happens isn't necessarily that there are more buyers or sellers. What it is, it's a sign that one group is more aggressive than the other. Now, there are various ways to think about support and resistance, but the one thing that you need to keep in mind is that quite often it is not a specific number. So for example, it's very rare that price will stop at 130 right on the pip and then turn around. That's generally not how it works. And that's because big players come in, big orders come in, and they try to get filled. And when they try to get filled, they don't want to take out everybody in one fell swoop, otherwise price moves against them. So they'll continually sell at price X, for example. That would be your resistance. So that's the larger amounts of trade volume, if you will. And if you think about it, it makes perfect sense because for every buyer, there has to be a seller. So on one price, we'll kind of draw this out here. Let's say there's 4 sellers, and this is going to be sellers and buyers, and there's 2 buyers here. There's 4 sellers at this price. One tick down, maybe there's 5 sellers, and there's 7 buyers, and then another tick down, maybe there's 2 sellers and 3 buyers. So what ends up happening is immediately these orders get matched up and you have 2 and 0, right? 2 sellers have sold to 2 buyers. So the question then becomes, are the sellers aggressive enough to drop down? Because right now you have 5 and 7. So if you drop down here and this becomes 7, that wipes everybody out and it's 0. 0's out. And then it comes down to here, 2 and 3. Well, unless somebody else jumps in, this will support the market. So you can see it resisted up here because there were 4 sellers and 2 buyers. And then we kept falling because these sellers jumped down to this lower price to take out these guys. And now here we are. So it's much like the best graphical definition is a dome, a depth of market in the futures market. It'll show you how many orders are at each tick. So in fact, there are always buyers and sellers, but some people will jump up or jump down to push price. And that's really what's going on here. So you should never think of it as there are more buyers than sellers. It's just that buyers are more aggressive. So now that we have that little bit out of the way, you should also keep in mind that because each tick represents where people get in and get out, and especially if they're trying to put, like, for example, say you've got 700 contracts of something to sell. Well, you don't put it all in one price because there might be 5 buyers and there might be 10 buyers and there might be 12 buyers, going down and down and down. And you could see if you just sold market, just said, okay, I'm going to sell 700 right here, you would drive price down so far by the time you got to your 700 contract, you'd be really working against yourself. So what happens is over time at price X, these big players, maybe they'll sell 20. Okay, well, they're down to 680. Well, next, maybe they'll sell 50. Okay, well, now they're down to 630 and so on. Buyers come in, maybe 10 come in and pick up 10 and 20 come in and pick up 20, and they just gradually work their way out. Because remember, the people that are causing the support and resistance are huge funds or central banks or somebody of that ilk. So with that in mind, how do we represent it on a chart? How do we look at it on a chart? Well, it's pretty straightforward. you can see, you click on the horizontal line tool, and just kind of click and hold and drag. And so, for example, notice right around here, the market, this is the monthly chart. So this was quite a while. Could not get above this area. So that would be resistance. Let's draw this again. So, like right down here, that's support. You can see we bounced, we dipped below it, we bounced from there, we bounce, we bounce, we bounce. And I'll notice, again, it's not to the tick. And that's where the trick is. Typically, what you will find, there are two things that you will find about support and resistance. So I'm going to go ahead and change this to 205, kind of see what happens. And this to 125. And let me draw another one at go ahead and drop down to the weekly, and I will zoom way out so you can really get a look at this. So notice what happens here when I put large round numbers. In this case, 170, 160, 155. So every 500 pips. Watch 150. Now, it doesn't have to follow this, but you can see there has been resistance here, support here, resistance, support, and then there's obviously been something going on there. We've been bouncing back and forth around it. Notice how it's been resistance here. It's showing resistance so far, support, 155, resistance. So what does this tell you? This tells you that large amounts of money come in around big figures. So that's the first thing that you should notice about support and resistance. The second thing is that there's an old adage that what was once the ceiling becomes the floor and vice versa. So think of it like a high rise. So let's say you're in a 4-story floor or a 4-story building. So if you're on the first floor and you go up to the second floor, you break above the ceiling and that becomes your floor. You break out to the third floor, that becomes your floor, which was once your ceiling. And you'll see this time and time again. So let me go ahead and even break down to the daily. And as I start to draw, you know, I'm just doing one every 500 pips. Edit that real quick. 140. There we go. So notice how this area here, we had broken above it and we pulled back to find support a couple of times. And that's what's meant by that. And so why is that going on? Well, that's going on because traders do not like the idea of taking pain, taking losses. So if you were selling this pair here, and it broke out against you and continued to rally. And, you know, here at about 142, you're really starting to feel the pain. So if you get anywhere near your sell point, psychologically speaking, most traders are more than willing to cover there, meaning buy it. So if they were short, now they're buying it. That causes support. They're trying to get out of that losing position, either at break even or with as little in the way of losses as possible. So that's why quite often you will see a lot of people talk about a breakout and a retest. Well, it's twofold. It's these people trying to get out of the market with as little damage as possible after being, you know, really worked against for several days in this case. Or there are also people getting FOMO, fear of missing out. They've seen the breakout. Now they have an opportunity. They saw where we were. Now they have an opportunity to pick up a little bit of value in what should continue to be an uptrend. And that's exactly what happens. So those are a couple of things that you really need to know about support and resistance that will play out time and time again. Another thing that you should take a look at, and I will pull up another chart here. This is the Aussie dollar monthly. So let's go ahead and let's start drawing. Let's do every 1,000 pips and see if we can find any type of pattern. Now, this is not to say that markets have to follow these exact levels. Sometimes you will see a support or resistance at a slightly skewed number, like it might be, in this case, 81. And I do think that it's there, and I'll show you why. And then I'll show you how you get really good at this. Okay, so how do you look at this? Well, let me go ahead and zoom down to the weekly. So this, to me, the 80 handle has caused resistance. 81 looks to cause resistance. So how do you kind of pull that together? How do you find that actionable? Well, the easiest way, quite frankly, is to look at this as a 100 pip thick line. So in other words, if you break the 80 level, and we did during this day here, by 6.5 pips, you don't go in and start buying. Number one, you need to see a candlestick close above it, even if you did take the 80. But your clue would have been these swing highs here where we pulled back. So this is an entire zone, if you will, of resistance. Now, what's interesting here, if you take a look at it, there's a little bit of selling there, but for the most part, if it breaks above here, and you can see we've tried multiple times, it could be free to go all the way up into this area. That's a pretty big move. I mean, this is a weekly chart. You're talking about 800 pips as an example. So when you have a large number that doesn't quite work out, quite often you will see something kind of close to it, and then you just think of it as a zone. That will save you a lot of headaches. There's another example of this right here on this chart. So there's 76, and you can see that 0.76 has been supportive. It's also been resistance, supportive. But what about the 75 handle? Large round figure, 500 point level. You see it's been supportive. The trick here is not to go overboard, but what you look for are areas of interest. So this tells me there's about 100 pips worth of resistance, 100 pips worth of support. And you can see this is weekly. So for about the last 3.5 months or so, the market has been hanging in a roughly 400 point range, really 300 if you take that little breakout. So you're consolidating. So you take this information and you say, okay, I don't want to trade weekly charts. I want to trade daily charts. And then you find where it's held as support, and you can be a buyer. You can be a seller up here as an example. You drop down to the 4-hour chart. You see another area here. Now, this is where I would warn you about getting too granular. Yes, I can clearly see that there is a certain amount of support going on right here. However, from a longer term standpoint, it may not matter as much. You know, you can see that there's a little bit of action there, but for the most part, it's a very noisy area. We have broken through it multiple times. And that's generally when you know that support and resistance is starting to give way, or have less meaning is probably a better way to put it, because we've sliced through it multiple times. We went sideways here, we broke through it, kind of sliced through it a couple different times, found support here, which is an area that has meant a lot more. So now we're just kind of in this stuck area. The smartest way to trade this, quite frankly, is to wait for the bigger areas to get touched. Now, keep in mind, you don't have to trade, in this case, the Australian dollar. There's no reason for you to trade it if the analysis is a little bit sloppy. That's another mistake that people make, because a lot of times what they'll do is they'll drill down to, in this case, like the 15-minute chart, or even like the 30-minute chart, and they go, okay, well, there's support and resistance there. So we dipped below it, but then we shot higher. So maybe I can be a buyer, but really, in the big scheme of things, you will find that if you are a little bit more patient, that's the route to go. Now, if you are a day trader, then you can go crazy, like on the 5-minute charts, and you can say, hey, there's support and resistance there. But at the end of the day, you need to pay attention to these bigger areas. So let's go ahead and pull up another chart. And in this case, I'll make it Euro Yen. And let's just go right down the line. And this is an exercise that you can do on the weekends when the markets are closed. And I would encourage you to do it in all markets, not just Forex, because at the end of the day, number one, it's a skill you can take other places. You can be a futures trader as well, or you can trade stocks for your retirement account, whatever you want to do. But you'll notice time and time again, there are areas where big money is getting involved. And, it's not as mysterious as people make it sound. Now, you have to understand that this is more like a roadmap to the markets. It's not a definite. Nothing is 100%. But you do have to realize that if you take trades, for example, around these 1,000 pip areas, you have much more of a chance of the market working out. And again, if you take a look at this and you say, okay, well, Euro Yen is up here, what am I going to do? Well, what you're going to do is you're going to find another pair to trade, unless you're a shorter term trader. But in general, you want to trade two things: with a trend and where support and resistance is. You want to be in tune with the market, because most of the time the market is just kind of grinding around. It really doesn't know where it goes, but eventually it makes a big turnaround, and then you can get involved. So remember the support and resistance, the building example? Well, this was your resistance at 130 yen in the euro. We pulled back and we found our buyers underneath here, and then turned around to show signs of strength again. Where do we go next? Well, there's a really good chance at this point we will probably try to get up to 135 at one point, or that general vicinity, and then 140 and so on. Now, you can make this as granular as you want, but unfortunately, I've seen a lot of traders out there put up monthly trend lines, weekly trend lines, daily trend lines, 4-hour trend lines, 1-hour trend line, and then the next thing you know, there's no room on the chart. So you do have to kind of conform it to your time frame. And as a general rule, you want support and resistance lines, at least one time frame higher, but really 2 or 3, because again, that's where all the big money gets involved. So you can take a chart like this, and you can just practice this on your own, and you'll say, okay, well, there are some things that don't look quite right? So let's go ahead and let's see what 115 does. Oh, look at that. It looks a little tighter on this chart now that it's there. Not as much room to move, granted, but that's 500 pips. You're not necessarily going to be trading Forex from the monthly chart. That's not the point. The point is it matters, and therefore it's where you should stand up and pay attention. And you will look for your signals at these levels, candlestick formations, whatever it is you use to enter, because there's about 1 million different ways to enter a trade. They also can be useful for take profit. So for example, let's go ahead and take this example here where we broke out and we pulled back. Well, where would you take profit? You could think about it there, or at the very least you have to be at break even there, because that's the next major area, and there's no need to give up 500 points worth of profit, obviously. Let's go ahead and break it down to the daily charts. You can see that we bounced here quite nicely. You can see we formed a long wick here, showing that there was going to be resistance. And again, 130 could have been your target. Which brings me to the next point. When you take this trade, somewhere below the 125 level could have been a good stop loss. And the reason being is because if we break that area, then we know that the big money has stopped buying. Pretty straightforward. You have to know these levels. They are guideposts for trading. Think of them as signs along the highway. Again, they don't have to be perfect. This one kind of was, actually, but you can see it wasn't back here, and that's the point. It just comes down to how many people are coming in at that point in time, whether or not the sellers are aggressive. The reason it turned around here is because either the buyers were very aggressive or maybe the sellers weren't. Either way, it didn't take much to push the market higher. I would also point out that you are better served following the overall trend. So in this case, since May 3rd of 2020, and as I record this, it is a year and 2 weeks later, clearly the proclivity of the market has to go higher. So really, you don't want to get stuck trying to sell it, even though it has pulled back a couple of times. Again, that is maybe where you take a little profit off the table. I hope you found this informative, and I would press upon you the thought of putting chart work in on the weekends, and pretty much anything that you can name. If you start to look at it, like stock markets will follow this as well. A lot of times you'll see support maybe at $32 or $32.50, but you see them at these big figures time and time again. Now, as we progress, we'll talk about different ways to get into a trade based upon these support and resistance levels, but you need to understand that they do exist in order to make sense of any type of technical analysis setup. Yes, you could have made money buying here, but there was really nothing there to tell you that. On the other hand, if you have a signal here after a breakout, or maybe a signal to get out here based upon a candlestick known as a shooting star, right at where you would expect to see a little bit of resistance, you really start to read the markets from a higher up kind of perspective. So hopefully you've learned a lot, and I would encourage you, go to various sites around the web where you can find charts and practice. Eventually you start to visualize this without much help at all.